Imagine you are about to buy a house.
Okay, a house.
Yeah. Now, a normal, rational person, they'd hire a structural inspector. You'd want to check the foundation for cracks.
Right, absolutely.
Make sure the plumbing isn't rusting out, check the roof for leaks, calculate the property taxes, all that boring stuff.
The due diligence, basically.
Exactly. But in this scenario, you skip all of that. You don't even look at the blueprint.
Sounds risky.
It does, right? Instead, you buy the house for one reason and one reason only. You pulled up to the open house and you saw 50 people standing on the front lawn, screaming out bids, just aggressively trying to throw cash at the seller.
Oh, wow. Okay, so just pure frenzy.
Pure frenzy. Now, in the traditional world of fundamental analysis, buying an asset just because other people are frantically buying it.
Well, that's usually called insanity.
Right. But in the world of technical analysis, that is called following the trend. And that is exactly what we are mastering today. So welcome to the deep dive.
I'm glad to be here for this one. It's a massive topic.
It really is. And we are doing a highly customized session today, specifically for you listening, because you are an MBA student. You are staring down the barrel of a massive exam on security analysis and portfolio management, and you basically need to completely conquer Unit 8.
Unit 8, right, which is your textbook's comprehensive guide to technical analysis.
Yep.
And honestly, it is a fascinating pivot from everything you've likely studied in your MBA program so far. I mean, up until this point, you've been trained to be that structural inspector. Right?
Exactly. You're usually deep in the weeds.
You've been reading balance sheets, calculating intrinsic value, evaluating liabilities, looking at, a company's earnings growth, their management team, their market share. You've been constantly asking, what is this company inherently worth?
Right. And then Unit 8 just kicks the door down and says, throw the balance sheet out the window.
It literally does.
Which, honestly, let me stop you right there for a second. Because as an MBA student who's probably spending late nights learning how to read a dense 10K report, it feels almost offensive to be told that none of that matters. I mean, do technicians really just ignore the financial health of the company entirely?
They absolutely do. Like, fundamentalists make their decisions based on quality, value, yield, financial strength, profitability, all those traditional metrics.
The nuts and bolts.
Exactly. But technical analysts, often called chartists or technicians, they believe that the performance of a stock is actually more relevant than the underlying company whose stocks are being traded.
Wait, the performance of the stock itself?
Yes. They evaluate securities purely by studying the statistics generated by market activity. So specifically, they look at past prices and trading volume. They're analyzing the behavior of the market itself, not the business generating the stock.
Okay, so just the numbers on the screen, not the factory making the widgets.
Exactly.
And the justification for this, I mean, it has to be rooted in a specific philosophy about human behavior, right? Because you need a pretty strong theory to justify ignoring a company's actual revenue.
You do. And your text provides this golden rule that you absolutely must memorize for your exam. Like, write this down. In technical analysis, it is a foundational belief that the market is 90% psychological and 10% logical.
90% psychological.
Yes.
That is a massive, massive shift from the efficient market hypothesis you learn in Econ 101.
Oh, it's the exact reverse of what is assumed in fundamental analysis. Technicians believe that the forces of demand and supply alone determine market prices. Period.
Okay, but a fundamentalist would argue that, well, demand and supply are driven by logical factors, right? Like a really positive earnings report?
Sure, they would argue that. But a technician argues that by the time that earnings report actually comes out, the market has already reacted.
Because the big players already knew.
Right. All those fundamental factors, all the rumors, all the insider knowledge, all the macroeconomic shifts, they are all instantly distilled and reflected in one single undeniable metric.
Which is the price.
The price people are willing to pay right now and the volume at which they are buying. That's all that matters.
Which brings us right back to the open house scenario I started with. Like, I don't need to know if the foundation is crumbling. If 50 people are fighting to buy it, the price is going up.
Exactly.
The overwhelming demand is driving the price, and as a trader, I just want to ride that wave of demand. I don't care about the foundation.
You just want to catch the wave.
So for the exam, let's make this super clear. If you get a multiple choice question contrasting the two philosophies, it's this. Fundamental analysis focuses on intrinsic value and logical financial metrics.
Right.
While technical analysis focuses on past price, volume, and the belief that trends are driven 90% by human psychology.
Precisely. The technician believes that shifts in demand and supply can be identified with the help of charts showing these market trends. They operate on the assumption that stock prices generally tend to move in a consistent trend,
Okay.
and that analyzing past market data actually aids in predicting future price behavior. Because human nature doesn't change, right? So the patterns of fear and greed on a chart, they just repeat themselves over and over again.
Fear and greed, the two classic Wall Street emotions.
Always.
So, to understand this mass psychology, we really need to look at who first tried to map it. Because these charts didn't just appear out of thin air on a Bloomberg terminal.
No, they didn't.
We have to travel back to, the late 19th century. Wall Street, telegraph machines, ticker tape.
Yeah, we're talking about Charles H. Dow, the undisputed godfather of technical analysis. The Dow theory is the absolute bedrock of charting, and it's going to be a massive component of your Unit 8 exam.
Charles H. Dow. I mean, the name obviously lives on in the Dow Jones Industrial Average.
Right. He was the editor of the Wall Street Journal, and he basically formulated this theory through a series of editorials.
Yeah.
And he didn't just write about these concepts abstractly. He actually built the indices to track them.
So he put his money where his mouth is?
Exactly. He created the Dow Jones Industrial Index, the DJIA, and the Dow Jones Transportation Index, the DJTA.
Okay, so industrials and transportation. And I feel like you have to understand the specific economic context of the late 1800s to see why he chose those two specific sectors, right?
You do. Dow believed that the stock market as a whole was a highly reliable measure of overall business conditions within the broader economy. He reasoned that if you analyze the overall market, you can accurately gauge the macroeconomic environment and identify major trends.
So why industrials and transportation? Why not, I don't know, banks or agriculture?
Because they represented the two absolute pillars of the Industrial Revolution economy. The industrial companies were manufacturing the goods, right? The steel, the textiles, the machinery.
Everything, the physical stuff.
Exactly. And the transportation companies, which back then were primarily railroads, were shipping those goods across the country.
Okay, that makes sense.
So if the factories were producing at maximum capacity and the trains were fully loaded moving that product, the economy was booming. But if the factories were producing and the trains were just sitting empty,
Then you have a massive inventory backup and a recession is probably coming.
exactly. It's a very simple but brilliant economic indicator.
That makes perfect sense for the 1890s. And just as a quick mental bridge for your MBA brain today, trying to modernize this, you can think of it like tracking semiconductor manufacturing alongside global shipping and logistics companies like FedEx or UPS.
Oh, that's a great modern analogy.
Right, because if the computer chips are being made and the packages are actually moving globally, the modern digital economy is healthy. Dow was just doing this with steel and steam trains.
That's spot on. But Dow didn't just look at a single line going up or down. He noticed that share prices exhibit three distinct types of price movements happening simultaneously.
Wait, simultaneously?
Yes. And this is an absolute gold mine for your multiple choice questions. You have to lock in these three overlapping trends and their specific timelines.
Okay, let's break these down step by step for the listeners.
So, the absolute foundation of Dow's theory is trend analysis. Dow observed that the market moves in a general direction, but it never moves in a straight line. It zigzags.
Never a straight line.
Never. It rallies up to a peak, sells off to a trough, rallies to a new peak. An uptrend is simply a series of higher highs and higher lows. A downtrend is a series of lower highs and lower lows.
Okay, so within that chaotic zigzagging line, what are the three specific trends Dow categorized? Let's get to the exam material.
First, we have the primary trend. This is the overarching macro movement. It represents the major bull and bear phases of the market.
So the really big picture.
Exactly. And for the exam, lock in this time frame. A primary trend typically continues for about a year or more, sometimes 1 to 3 years. It is the overriding trend that dictates the macro direction of the market.
Right, so the primary trend is the macroeconomic supercycle. If we use the massive bull market of the 2010s as an example, the primary trend was undeniably upward. It's the massive, unstoppable shift in the economic tide.
Good analogy. The tide.
Okay, so what is the second trend?
Second is the secondary trend, which is also referred to in your textbook as the intermediate trend.
Secondary or intermediate, got it.
These are secondary movements or technical corrections that move against the primary trend.
Wait, against it.
Yes. And the time frame here is vital for your exam. They last anywhere from 3 weeks to 3 months. They represent temporary adjustments to the excesses that occur in the primary movements.
So let me make sure I'm visualizing this right. If the primary trend is a multi-year bull market, so prices are marching upward year after year, the secondary trend would be a sudden, sharp downward correction that lasts for, say, a couple of months.
Exactly. It's a sharp rally in a bear market or a painful correction in a bull market.
Yeah.
And your textbook gives us some highly testable, very specific details here regarding the math of these retracements.
A retracement meaning how much it drops.
Right, how much ground the secondary trend gives back relative to the primary trend. Dow observed that this retracement usually ranges between 1/3 and 2/3 of the primary trend's movement, so between 33% and 66%.
That's a huge drop, potentially.
It is. And he noted that the price action within a secondary trend is often much more volatile than the steady march of the primary trend.
Okay, let's pause and push beyond just memorizing the numbers here, because as an MBA student, you need to understand the why. Why does a market reliably retrace 33% to 66%? What is the actual human psychology behind that specific mathematical drop?
That is the perfect question, because remember, technical analysis is just applied psychology.
Right.
Imagine a stock has been on a massive tear, moving from $100 up to $200 over a year. That's a 100-point primary trend upward.
Great year for that stock.
A fantastic year. But at $200, the early investors who bought at $100 are sitting on a 100% gain. Human nature dictates that eventually the fear of losing those profits kicks in.
They want to lock it in.
Exactly. So they start selling. This localized selling pressure halts the upward momentum and pushes the price down.
So the smart money basically starts cashing out, taking their ships off the table.
Right. And as the price drops down to, let's say, $166, which is exactly the 33% retracement of that 100-point gain, a new psychological force enters the market.
Which is what? Greed.
Pure greed. You have a whole cohort of investors who watched the stock go from $100 to $200 with intense FOMO fear of missing out. Now they see the stock sitting at $166.
And they think, oh, it's on sale.
Exactly. They don't see a crashing stock. They see a 33% discount on a confirmed winner. So they aggressively step in and start buying, catching the dip.
Right.
This renewed buying pressure halts the secondary correction and resumes the primary upward trend.
That is fascinating. And if the fear is stronger, I assume it might drop 50% or 66% before those bargain hunters feel confident enough to actually step in. It is literally a tug-of-war between profit-taking fear and bargain-hunting greed. I love that.
It really is.
So we have the primary trend lasting years, the secondary trend lasting weeks to months, and retracing 33% to 66%. What is the third movement?
The third is the minor trend, also called daily movements.
Minor or daily? Okay.
These last for less than 3 weeks, often just a few hours to a few days. In Dow theory, these are considered the least significant. They are the random, chaotic, day-to-day wiggles.
Just the wiggles.
Yeah, they are the localized corrective moves happening within a secondary move.
So they're basically the background noise. If the primary trend is the climate and the secondary trend is the season, the minor trend is just the daily weather.
That's a brilliant way to phrase it.
Proponents of Dow theory don't focus heavily on minor trends because, what, they are too easily manipulated by short-term news cycles? They just carry very little predictive signal.
Correct. You observe the minor trend, but you only analyze it with the larger primary picture in mind. You don't let a rainy day convince you that winter has arrived.
Okay, so Dow theory maps the market into these overlapping trends. But practically speaking, for a trader sitting at a Bloomberg terminal, this presents a massive logical problem.
How so?
Well, if a stock drops sharply for a week, how do you know if it's just a temporary secondary correction that you should buy, or if the primary macro trend has actually reversed and the whole market is crashing? Like, how do you know when the tide is actually turning?
That is arguably the single most difficult aspect of trend analysis, and it's where many amateur traders completely lose their shirts.
Like that.
But the text is very clear on how Dow theory handles this dilemma. A core tenet is that traders must identify the direction of the primary trend and trade with it, not against it, until the weight of evidence definitively proves that the primary trend has reversed.
Wait, until it's definitively proven?
Yes.
Yeah.
You must assume the primary trend is intact until it mathematically breaks.
Ah, the classic saying, the trend is your friend until the end when it bends. Trade with the trend until the weight of evidence says otherwise. Got it. So Dow establishes that markets move in these zigzagging psychological waves. But riding the wave isn't enough, right? As an analyst, you need to know exactly where that wave is going to crash into a seawall. You need to know where the trend is going to pause or reverse.
Which perfectly transitions us into the architecture of price itself.
Yeah.
We are moving beyond just identifying the trend to actually mapping the physical boundaries of that trend on a chart.
Okay, let's get into it.
We are talking about support, resistance, and volume.
These are terms you hear thrown around constantly on CNBC or Bloomberg, but for your exam, we need precise mechanical definitions. So let's start with support. The textbook defines a support level as a price level that tends to act as a floor, preventing the price of an asset from being pushed downward.
Yes, imagine a stock's price is dropping rapidly. It's in free fall. But when it hits exactly $50 a share, it suddenly stops dropping and bounces back up.
Just hits a wall, or a floor, rather.
Exactly. And if it falls to $50 a month later, it bounces again. That $50 mark is the support level.
And why does it bounce?
Because $50 is the psychological area where a critical mass of market participants see undeniable value. They step in with massive buy orders, and this influx of demand absorbs all the selling pressure, acting as a literal floor.
And the mirror image of that would be resistance.
Correct. Resistance levels are regarded as a ceiling. These are price levels that prevent the market from moving prices upward.
So as the stock climbs, it hits a roof.
Right. As the stock climbs to, say, $100, it hits a level where current holders decide the stock is either overvalued or they simply want to lock in their profits. They start selling their shares.
And that floods the market with supply.
Yes, this sudden influx of supply creates a ceiling that the upward momentum struggles to break through.
Okay, let's unpack this mechanism because this is where technical analysis can feel a little bit like voodoo to a fundamental MBA student.
I hear that a lot.
Let's use the analogy of a glass floor and a glass ceiling. Every time the price drops and hits the glass floor, the support level, it bounces. But if everyone looking at the same chart sees that the glass floor is at $50, doesn't it just become a massive self-fulfilling prophecy?
What do you mean?
Well, if I know support is at $50, I'm going to set my automated buy order at exactly $50.01. And if 10,000 hedge funds do the exact same thing, of course the price won't drop below $50 because there is an artificial, impenetrable wall of buy orders waiting right there in the order book.
Right. But that isn't voodoo. That is exactly how market mechanics work.
Really?
Yes, your observation is astute, and it highlights a known characteristic of technical analysis. Because the market is 90% psychological, mass psychology and collective behavior absolutely play a major role.
So they do kind of manifest the floor.
If enough institutional traders believe a support level exists, their collective capital will manifest that support level in reality. However, the market is a relentless testing machine. It will constantly hammer against that glass floor or that glass ceiling.
It doesn't just stop trying.
No, it tests it. And the true test of whether that glass will hold or whether it will shatter is determined by our next critical concept, volume.
Volume. Dow gave special emphasis to volume, and in technical analysis, volume acts as the ultimate lie detector. Volume is simply the number of shares being traded during a specific period.
Well.
So if a price jumps up, but hardly any shares were actually traded to make it move, it's a weak signal.
Precisely. Technical analysts use volume to confirm the conviction behind a trend. To continue your analogy, if hitting resistance is like a hammer striking the glass ceiling, volume represents the weight of that hammer.
Oh, I like that.
Right. A 10-pound hammer hitting the glass is going to do a lot more damage than a 1-ounce hammer. You need to know the specific bullish and bearish volume signals for your exam.
Okay, let's lay them out clearly for the students. Scenario 1. The stock price is increasing, it's moving upward. And this price increase is accompanied by heavy volume, meaning the number of shares trading hands is significantly higher than the daily average. What is that signal?
That is a very strong indication of bullish activity.
Mm-hmm.
The price is rising, and there's a massive amount of market participation driving it.
Hmm.
The heavy volume confirms that the upward trend has immense conviction behind it.
Okay, scenario 2. The price is declining, and it is accompanied by heavy volume.
That is highly bearish. A massive amount of shares are being aggressively dumped to drive that price down. The downward trend is strong, validated, and dangerous.
Okay, so heavy volume validates the direction of the movement, regardless of whether it's going up or down. Heavy volume means it's real.
Yes.
But what happens when the volume is extremely light? The textbook specifically mentions situations where small price reversals occur with light trading volume.
Think back to our primary and secondary trends. Let's say the primary trend is a strong bull market. Suddenly the price drops a little bit, it reverses.
So red day.
Right.
Yeah.
But you look at the volume and it is incredibly light. Very few shares are actually trading hands. What does that tell you?
That no one cares.
It tells you that there is very limited interest in selling off this stock. A few retail traders might be taking minor profits, causing a temporary dip, but the massive institutional players are holding their positions. They are rushing for the exits.
Ah,
Therefore, the lack of heavy volume tells you this reversal is just a minor correction, and the primary upward trend remains completely intact.
I love that lie detector concept. You just can't fake volume. So for the exam, price up plus heavy volume equals bullish. Price down plus heavy volume equals bearish. A small reversal against the trend with light volume equals limited conviction, meaning the main trend is safe.
Spot on. Now, examining a single stock's support, resistance, and volume is crucial for individual trades. But as an MBA, you aren't just looking at isolated assets. Technicians need to step back and evaluate the health of the entire macroeconomic market at once.
Which takes us right into analyzing the overall market health. Looking at one stock hitting a glass ceiling is one thing, but what if you need to know what the whole forest is doing? The primary tool for this broad macro view is called breadth of the market.
Market breadth is a brilliant mathematical concept. It is used to study the underlying momentum of the market by tracking the advances and declines that have occurred across an entire stock exchange on any given day.
Let's define those terms so you can nail this on the multiple choice section. Advances simply means the total number of individual companies whose stock prices increased compared to the previous day's closing price.
Right.
And declines is just the total number of companies whose stock prices fell.
And the math behind the breadth of the market is straightforward but highly revealing. You take the number of advancing stocks and subtract the number of declining stocks. This gives you the net advances or the net breadth for that specific day.
Okay, let's use some real numbers just to visualize it. Let's say on Monday, across the New York Stock Exchange, 630 stocks advanced and 527 declined. Your net breadth is positive 103.
Good.
On Tuesday, it's a great day. 690 advance and 475 decline. That's a net of positive 215.
But calculating a single day isn't enough to track a trend. The crucial step in market breadth analysis is creating a cumulative index.
You add them together?
Yes.
Yeah.
You add Tuesday's net to Monday's net. So positive 103 plus positive 215 gives you a cumulative breadth of 318. You keep this running total going indefinitely.
Okay.
If Thursday is a bloody day and you have more declines than advances, say a net of negative 138, you just subtract that from your cumulative total.
So you generate this running cumulative line that rises and falls based on the democratic participation of the entire market. Every stock gets a vote.
Exactly.
Now, why go through the trouble of calculating this? Why not just look at the Dow Jones Industrial Average or the S&P 500?
Because market indices can be deceiving. The major indices are often weighted by market capitalization.
Oh, right. Apple and Microsoft.
Exactly. This means a handful of massive tech companies can drag the entire Dow or S&P 500 upward, making the market look incredibly healthy, even if hundreds of smaller companies are actually losing value.
So the index is lying.
It's hiding the truth. The breadth of the market reveals the true underlying health. Ordinarily, the cumulative breadth line should move in tandem with the major indices. If the Dow is hitting new highs, the breadth line should be hitting new highs, proving that the rally is broad-based and supported by the majority of companies.
And here is where it gets highly testable. The exam focus here is on a concept called divergence. What happens when the major index and the market breadth start moving in opposite directions?
Divergence is a massive, flashing warning signal for a technical analyst. Let's say the Dow Jones is moving upwards, hitting all-time highs every single week. The financial news is cheering.
Everyone is happy.
But your cumulative breadth line is quietly moving steadily downwards.
So the five-star generals are charging up the hill, making all the headlines, but the actual troops are retreating.
That's a perfect analogy. That divergence indicates that the upward trend is structurally weak. It is not supported by the broader market. A few mega-cap stocks are doing all the heavy lifting.
And they can't do it forever.
No. Technicians view this divergence as a strong signal that the market is exhausted and is highly likely to turn bearish. The heavy lifters will eventually buckle under the weight of the declining majority.
And I'm assuming the reverse is equally true. If the Dow is dropping and the headlines are filled with doom and gloom, but the breadth of the market is steadily moving upwards,
Yes.
it signals that beneath the surface, the troops are actually advancing. More and more individual stocks are gaining ground. That divergence signals the market is quietly building strength and may soon turn bullish. The divergence is the tell. It reveals the lie of the index.
Exactly. Now, while we are discussing these broader market mechanics, your text outlines two specific trading mechanisms that you need to thoroughly understand: short selling and odd lot trading.
Let's tackle short selling first. Normally, when you invest, you buy a stock hoping the price goes up. You buy low, sell high. That's called going long.
Right.
Short selling is the exact opposite. You are betting that the price of the asset is going to crash.
But the mechanics of how you make money on a falling stock are what you need to understand for the exam. To execute a short sale, you are literally selling a security that you do not own.
Which sounds illegal, but it's not.
It's completely legal. You complete this initial sale by delivering a security that you have borrowed, typically from your brokerage firm's margin account.
Let's walk through this step by step for the MBA student, because understanding the mechanics here is vital, especially when we look at historical anomalies like the GameStop saga.
Definitely.
Step 1. You think Company X is going to zero. So you borrow 100 shares of Company X from your broker.
Okay.
Step 2. You instantly sell those borrowed shares on the open market at the current price, say $50 a share. You pocket the $5,000 cash.
But you still owe your broker 100 shares of Company X. You have an open liability.
Right. So your entire thesis is hoping the price drops. Let's say your analysis is right and the company completely implodes. The stock price plummets to $10 a share.
Good for you.
Step 3. You go back into the open market and buy 100 shares at the new low price of $10. That costs you $1,000. Step 4. You return those 100 shares to your broker, settling your debt. You keep the $4,000 difference as pure profit. You sold high and you bought low, just in reverse order.
That is the perfect mechanical explanation. Short sellers make money by providing liquidity and betting against the security. But as an MBA, you also need to understand the structural risk.
Oh, the risk is massive.
When you buy a stock normally, your risk is capped. If you buy at $50, the worst can happen is it goes to zero and you lose $50. But when you short a stock at $50, your potential loss is mathematically infinite.
Infinite.
Yes. If the stock unexpectedly rallies to $500 or $5,000, you are still legally obligated to buy those shares back to return to your broker, no matter how high the price goes.
Which is exactly what a short squeeze is. If a heavily shorted stock suddenly starts rising, all those short sellers panic. They are forced to buy shares at market price to close out their bleeding positions.
And that buying just pushes it higher.
Right. All that forced panic buying drives the price up even faster, which triggers more short sellers to get margin called and forced to buy, creating a violent upward spiral. That's exactly what happened with GameStop. The technicians look at short interest, the total number of shares currently sold short, as a volatile fuel source for future price movements.
Absolutely.
Now, what about the second mechanic? Odd lot trading.
Well, to understand an odd lot, you first have to know what a round lot is. Historically, the standard unit of trading for stocks on major exchanges is 100 shares. That 100-share block is a round lot.
Okay, so round is 100.
An odd lot is an order for any amount of a security that is less than that standard 100 shares. For example, an order for 12 shares or 47 shares.
Why does the textbook spend time pointing this out? It seems like a pretty trivial administrative detail.
It's important for historical context and for understanding retail versus institutional footprints. Historically, trading in odd lots was penalized. It was much more expensive because brokerage firms charged higher commission percentages on non-standard orders.
Just harder for small fish.
It was a friction point that kept small retail investors at a disadvantage. However, your text correctly highlights that the massive popularity of modern online trading platforms, zero-commission structures, and the advent of fractional share buying has fundamentally altered this landscape.
Right.
It is no longer difficult or prohibitively expensive to trade odd lots.
Yeah, today a retail trader on an app can buy 0.5 shares of Amazon without thinking twice. Technicians used to track odd lot trading as a proxy for dumb retail money, assuming the small odd lot traders were always wrong at market turning points.
But that indicator has largely lost its edge in the modern era. Still, you need to know the definition for the exam. Odd lot equals less than 100 shares.
Exactly. Now, moving from market mechanics to market psychology, we have to look at sentiment indicators. These are fascinating metrics because they often require a completely contrarian mindset. The first one you need to firmly grasp is the mutual fund liquidity ratio.
This ratio compares the amount of liquid cash a mutual fund holds relative to its total assets. Equity investors track this ratio to gauge the overall sentiment of massive institutional fund managers. Are these billion-dollar whales feeling bullish or bearish?
And here is where the logic feels completely upside down until you really think about it. Let's walk through the mechanics so you don't trip up on the exam.
Let's do it.
Let's say you analyze the mutual fund industry, and you see that they are sitting on historic, massive piles of cash. A huge percentage of their total assets is just parked in liquid cash, not invested in the market. Is that high liquidity a bullish or bearish indicator of sentiment?
Well, instinctively, having a ton of cash sounds great. Cash is king, right?
Great, usually.
But in this specific context, high mutual fund cash levels indicate a heavily bearish sentiment.
Bearish, exactly. Why? Because a mutual fund manager is paid millions of dollars to invest capital and generate returns. If they're holding unprecedented amounts of cash, it means they are looking at the current market and they cannot find a single stock worth buying.
They hate the prices.
They believe prices are too high, or they are terrified that a massive crash is imminent. So they pull their money out of equities and hide in cash. Therefore, high mutual fund liquidity proves that institutional sentiment is overwhelmingly bearish.
They are too scared to deploy their capital. That makes perfect sense. Conversely, if mutual funds have incredibly low liquidity, meaning they are nearly fully invested with almost zero cash on hand,
Then what?
the logic dictates that they are wildly optimistic. They have found excellent investing opportunities everywhere they look, and they are taking full advantage of them. They have deployed every dollar they have. Therefore, low cash levels indicate a highly bullish sentiment.
Okay, here is the MBA level insight to connect this to the real world. While high cash means the current sentiment is bearish, contrarian traders often view high mutual fund cash as a bullish signal for the future.
Wait, how does that work?
Because all that cash is dry powder. Eventually, those fund managers have to put that money back to work. When sentiment shifts and they start buying, that massive wall of cash re-entering the market will drive prices to the moon. So they are bearish now, but they represent explosive bullish fuel for later.
Oh, that's a great nuance.
But for the exam question asking strictly about sentiment, high cash equals bearish sentiment. Low cash equals bullish sentiment. Keep it simple for the test.
A vital distinction. The second major sentiment indicator you must know is the put-call ratio. To understand this, we briefly need to define the underlying options mechanics.
Let's do a quick refresher. In options trading, a call option is a contract that gives you the right, but not the obligation, to buy a stock at a certain price in the future.
Right.
You generally buy call options when you expect the stock price to surge upward. It's an aggressive, leveraged bet on a price increase.
And a put option gives you the right to sell a stock at a specific price. You buy put options when you expect the stock price to drop. It acts as insurance or as a direct bet against the stock.
So broadly speaking, heavy buying of calls indicates a bullish mindset, and heavy buying of puts indicates a bearish mindset. The put-call ratio is simply a fraction. It takes the total trading volume of put options and divides it by the total trading volume of call options.
And technicians view this ratio as a real-time thermometer for market fear and greed. If the number of traded call options is massively outpacing the number of traded put options, the ratio drops. This signals a broad, euphoric, bullish sentiment in the market. Everyone is aggressively betting that stocks will go up.
Because the denominator is bigger.
Exactly. If put options heavily outpace call options, the ratio spikes, signaling pervasive fear and bearish sentiment.
But the textbook gives a pro tip here. Savvy technical analysts aren't just looking at the static daily number, they're looking for violent changes or swings in the ratio.
Yes, when sentiment reaches absolute extremes, when everyone is overwhelmingly bullish or overwhelmingly bearish, contrarian technicians start looking for the snapback.
The rubber band effect.
Exactly. Changes in the put-call ratio represent a shift in the overall tide of mass psychology. If the market has been blindly bullish for months, driving call volumes through the roof, but suddenly the volume of puts starts quietly but sharply spiking, a technician sees that the fear is creeping back in.
The tide is turning.
The tide is turning. By getting ahead of that shift in the ratio, traders can position themselves before the actual stock prices crash to reflect that new fearful reality.
Okay, we have covered a massive amount of ground. We've mapped out Dow's macro trends, the glass floors of support and resistance, market breadth, and the contrarian psychology of sentiment indicators.
Oh.
But let's get back to the actual chart.
Back to the visual stuff.
We know that daily price movements, the minor trends, are incredibly chaotic. The stock goes up $2, down $3, up $1. It's visual noise. How do traders mathematically smooth out that chaos so they can actually see the underlying primary or secondary trend?
That brings us to the mathematical toolkit of technical analysis. And the absolute cornerstone of this toolkit is the moving average. A moving average is exactly what it sounds like. A constantly updating mathematical line that smooths out past price data over a specific period of time.
Now, I know you are an MBA student, so you know how to calculate an average. I'm not going to insult your intelligence by explaining basic division.
Probably a good idea.
But I want to explore why the textbook uses a 5-day moving average as its primary example and how this tool actually generates trading signals.
The time frame you choose for a moving average drastically changes its sensitivity. A 5-day moving average takes the closing prices of the last 5 days, averages them, and plots a point. The next day, it drops the oldest day, adds the newest day, and plots a new point.
Very simple.
Because it's only looking at 5 days of data, this line is going to hug the actual daily stock price very closely. It's highly sensitive to recent changes.
Right. And if you use a 200-day moving average, it's taking the average of the last 200 trading days. That line is going to be incredibly slow, smooth, and sluggish. It won't react to a sudden 3-day news panic.
No, it filters the noise out completely.
Traders use the 5-day or 10-day averages to track fast, short-term trends, and the 50-day or 200-day averages to track the macro Dow theory primary trends.
Furthermore, these moving average lines actually act as dynamic curving levels of support and resistance. In a strong uptrend, you will frequently see a stock's price dip, perfectly touch its 50-day moving average, find support right on that mathematical line, and bounce back up.
Wow, so the moving average becomes the glass floor.
Yes. In a downtrend, that same moving average acts as a descending glass ceiling, capping any attempted rallies.
Wait, let me challenge this entire concept because this is a major criticism of technical analysis.
Go for it.
If a moving average is, by definition, calculated using past closing prices, isn't it inherently a lagging indicator? You are essentially trying to drive a car forward at 100 miles an hour by only looking in the rearview mirror. How can a lagging mathematical average of the past generate a valid signal for what the stock will do tomorrow?
It is absolutely a lagging indicator, and fundamentalists love to point that out. A simple moving average, or SMA, gives equal weight to a price from 200 days ago and a price from yesterday.
Which seems flawed.
To combat this, sophisticated technicians often use an exponential moving average, or EMA, which applies heavier mathematical weighting to the most recent days, making it react faster to current market shifts. However, the true predictive power isn't in the line itself. It is in how the current real-time price interacts with that lagging line.
Which brings us to the most testable part of this section. How a moving average generates concrete buy and sell signals. The jagged daily price line will frequently intersect the smooth moving average line. What are the specific triggers you need to memorize?
Let's start with the buy signal. Technical analysis dictates that a clear buy signal is generated when the stock's actual price line rises forcefully through the moving average line. Specifically when the moving average line itself has stopped falling and is flattening out.
Let's visualize that. The stock has been in a downtrend. The moving average is sloping downward. But eventually, the selling exhausts. The moving average line levels out horizontally. Suddenly, the daily price violently punches upward, breaking through that flattened average.
That crossing point is your buy signal. The trend is demonstrably reversed.
Okay, got it.
Another valid buy signal occurs if the stock price is already trending above the moving average, then falls to touch the moving average line, but immediately bounces and begins to rise again. It successfully tested the moving average as a support floor, and the floor held strong.
And the sell signal is just the mirror image of this logic.
Exactly. A sell signal is triggered when the stock price falls dramatically through the moving average line. Again, particularly when that moving average has flattened out at a peak. Furthermore, if the stock is below the moving average, rallies up to touch it, but is rejected and drops again, testing that resistance and failing, that is a secondary sell signal.
Okay, so the interplay between the chaotic daily price and the smoothed average is what generates the timing signals. And if you put a short-term 50-day average and a long-term 200-day average on the same chart, when the fast line crosses up through the slow line, technicians call that a golden cross, a massive macro buy signal. If it crosses down, it's a death cross.
Right, those are huge terms in the industry.
The other mathematical tool highlighted in your text is relative strength analysis. This is purely a momentum play.
Relative strength analysis is a strategy to sort through the noise of thousands of publicly traded companies to mathematically identify the individual stocks with the most violent upward momentum. It's essentially a proprietary ranking system.
How does a trader practically execute this, like day to day?
You take an entire universe of stocks, say the S&P 500. You calculate a mathematical strength rating for each stock based on its performance over a specific look-back period, often a few weeks or months. Then you rank them all from 1 to 500.
Simple enough.
The following week, you run the calculation again. The goal isn't just to see who is at the top. The goal is to identify which stocks are rapidly accelerating up the rankings relative to their peers.
It's like evaluating runners in a marathon. You don't necessarily want to bet on the guy who has been leading for 20 miles because he might be exhausted. You want to bet on the runner in 50th place who is suddenly sprinting and passing 5 people every minute. You are betting on the acceleration of momentum.
Exactly. The psychology of momentum is a powerful force. When a stock demonstrates immense relative strength, it triggers institutional herding and retail FOMO. The text explicitly cautions that past performance doesn't guarantee future results.
As all financial texts do.
Right. However, historically, a strategy of systematically buying the top 10 or 20 stocks demonstrating the highest relative momentum has proven to be a highly profitable way to ride the psychological waves of the market without needing to manually inspect hundreds of individual charts.
Okay, we have talked about all this data conceptually, prices, volume, moving averages, momentum rankings, but you can't just stare at a spreadsheet. The human brain needs a visual interface to spot these patterns. How do analysts actually visualize all this data?
Charts are the literal lifeblood of technical analysis. They provide the visual translation of raw data, allowing the human eye to instantly detect changing patterns of mass psychology. Your textbook outlines 3 core types of charts that you absolutely must be able to differentiate for the exam.
Let's break them down visually. The first and most rudimentary is the line chart.
The line chart is the absolute most basic representation. It is created simply by plotting a series of single data points, most commonly the final closing price of a stock for the day, and connecting those dots with a single continuous line. It tracks purely the closing price action over time.
So if you just plot the 4:0 p.m. closing price every single day and connect the dots, you have a line chart. It's clean, it's simple, and it's great for a quick 10-year macro view of a company.
It is.
But from a trader's perspective, it hides a terrifying amount of critical data. You have absolutely no idea what happened between the opening bell at 9:30 a.m. and the closing bell at 4 p.m. The stock could have crashed 50% and recovered, and the line chart would just show a flat line.
Which is exactly why serious technicians rarely rely solely on line charts. They prefer the second type, the bar chart. A bar chart provides significantly more granular information. It represents data using rectangular vertical bars. Each individual vertical bar represents the entirety of a specific time frame. For example, one single day of trading.
And what specific data points does that single vertical bar show us?
It displays the OHLC data, open, high, low, and close. The absolute top tip of the vertical bar represents the highest price the stock achieved at any point during that day. The absolute bottom of the bar represents the lowest price it hit. Then there are 2 small horizontal tick marks. A tick mark on the left side of the vertical bar denotes the exact opening price. A tick mark on the right side denotes the closing price.
So with a quick glance at a single bar, you know the entire trading range of the day, how volatile it was, where it started and where it finished. That is vastly superior. But then we get to the third type, which the text highlights as the most readable and widely used in modern trading, the candlestick chart.
The candlestick chart originated in Japan hundreds of years ago for trading rice contracts. It provides the exact same OHLC data open, high, low, close. But it uses visual shading to make the daily momentum instantly recognizable to the human eye. The thick, vertical rectangular area between the open price and the close price is called the real body of the candle.
And the thin lines sticking out of the top and bottom of that real body are the wicks, or the shadows. Just like the bar chart, the top of the upper wick represents the highest price of the day, and the bottom of the lower wick represents the lowest price.
But the true brilliance of the candlestick is the color shading of the real body. If the real body has a dark shade, it means the stock closed at a higher price than it opened. The buyers won the day. It was a day of upward, bullish momentum.
Okay.
If the candle has a light shade, it means the stock closed lower than it opened. The sellers overpowered the buyers. It was a bearish day.
Now, a very important note for you as you take this exam. If you open Robinhood or any modern trading terminal right now, this shading is almost universally represented by the colors green for bullish and red for bearish.
Very true.
However, your textbook specifically uses the classic print-era terminology of dark shade for bullish and light shade for bearish. When you are sitting for the Unit 8 exam, do not look for green and red. Strictly stick to the textbook's dark and light terminology to avoid getting tripped up.
Excellent point. The visual power of a candlestick chart allows a trader to instantly discern the momentum of a series of days just by looking at the sequence and size of the shaded bodies. A long, dark body means the buyers dominated from the opening bell to the close. A long, light body means aggressive panic selling.
Okay, so we know how the charts are physically constructed. Now, what specific psychological shapes or patterns are the technicians actually looking for on these charts? Your text highlights a few specific patterns that reliably signal trend reversals, and these are highly testable. Let's start with the saucer.
A saucer pattern is beautifully descriptive. It looks exactly like a shallow bowl or a saucer on the chart. A saucer bottom indicates a very specific psychological shift.
How so?
Well, the stock price has been declining for a while, but the violent downward momentum slowly begins to round off. The selling pressure is gradually exhausting. It reaches its support level, the bottom of the bowl, and the curve begins to very slowly, gently turn upward as quiet buying pressure takes over. It suggests the stock has stabilized, found a rock-solid floor, and has nowhere to go but up.
It's a gentle, rounded, non-violent trend reversal. The panic has subsided. And what about a saucer top?
It's the exact opposite, an inverted bowl. The stock has experienced a long climb, but the buyers are getting tired. The upward momentum rounds off as it hits a massive resistance ceiling, and the trend slowly, almost imperceptibly, reverses downward. The text also specifically notes that the horizontal band of space between these gradual support and resistance levels is referred to as the trading channel.
Got it. Now brace yourself, because here is the biggest exam alert of this section. We are going to talk about the head and shoulders pattern. You will almost certainly see a detailed question on this.
The head and shoulders is the most famous classic indicator of a major trend reversal in all of technical analysis. Visually, it consists of three distinct peaks. The first peak is the left shoulder, which is followed by a moderate dip. The second peak surges much higher than the first. That forms the head, which is then followed by another significant dip. Finally, the third peak rises, but it fails to reach the height of the head. It roughly equals the height of the first peak. That forms the right shoulder.
Left shoulder, a higher head, and a lower right shoulder. Okay, but again, as an MBA, we need the why. What is the actual human psychology playing out across these three peaks?
It is a visual representation of a market trend slowly dying of exhaustion. During the left shoulder, the bull market is strong. Buyers push the price up to a new high, take some profits, and it dips.
Normal behavior.
Exactly. During the head, irrational exuberance takes over. Buyers aggressively surge the price to an incredible, massive new high. But crucially, if you look at the volume during the head is often lower than the left shoulder. The rally is running out of gas. It dips again.
Okay, then the right shoulder happens.
Finally, on the right shoulder, the buyers try to rally one last time. But they are completely exhausted. The buying power fails miserably to reach the previous high of the head. The failure of the right shoulder proves the bulls are dead, the bears take over, and the price plummets.
So a standard head and shoulders pattern is a massive, highly bearish signal. It screams that an upward trend has exhausted itself and a crash is imminent. Technicians consider the completion of the right shoulder as a definitive signal to sell everything.
Exactly. And what if you take that exact same pattern and flip it upside down?
That is called an inverted head and shoulders. It looks like a valley, followed by a much deeper valley, followed by a shallower valley.
Yes. An inverted head and shoulders is a highly bullish signal. It indicates a painful downward trend is finally exhausting itself. The sellers try to push the price to a new, devastating low, the inverted head, but then they fail to push it that low again on the right shoulder. The selling pressure is dead. The buyers step in, and it reverses upward.
Standard equals bearish. Inverted equals bullish. Lock that into your memory. The next pattern is the breakout. We touched on this with the glass ceiling analogy, but let's formalize the textbook definition.
A breakout occurs when a stock's price violently and decisively penetrates through a clearly defined historical support or resistance level.
But the key validating component of a true breakout is our lie detector, right? Volume.
Absolutely. If a stock price simply drifts above a resistance ceiling on a quiet Tuesday afternoon with zero volume, technicians largely ignore it as a false signal.
It's a fake out.
Exactly. But if a stock price breaks out through a massive multi-year resistance ceiling, and that breakout is accompanied by explosive, higher-than-usual trading volumes, technicians consider this one of the strongest bullish indicators in existence. It means the stock has completely conquered the historical selling pressure.
The glass ceiling is shattered.
Shattered completely. According to technical analysis, the stock is now in price discovery mode. It is looking to establish a brand new, significantly higher resistance level, and it may continue climbing rapidly on that momentum for months.
It broke through the ceiling with a sledgehammer, and now it's sprinting up the stairs to the next floor. The final charting technique we need to cover in this section is the accumulation distribution line. This is a brilliant concept because it perfectly marries price action and volume flow to reveal what the smart money is doing behind the scenes.
As we've established, changes in volume almost always precede changes in price. Right before a stock price suddenly surges, there is frequently a period of subtly but steadily increasing volume. The accumulation distribution line mathematically identifies these hidden divergences between the visible stock price and the invisible volume flow.
Let me give you the logic to memorize this for the exam because initially it sounds contradictory. The text states, if the price is declining but the volume is increasing, it is a bullish sign. Wait, price dropping means bearish, right?
That's the intuition, yes.
Yeah. But think about the massive institutional players. The hedge funds with billions of dollars. The smart money. They can't just buy a million shares at once. They would spike the price and ruin their own trade.
Right, they have to hide their moves.
Exactly. So if the visible price is slowly drifting downward, but the volume is massively surging, it means these giant institutions are quietly stepping in and absorbing all the panic selling. They are secretly buying massive amounts of shares on the cheap. They are accumulating the stock. That huge, hidden, coiled spring demand will eventually overwhelm the sellers and drive the price violently upward. So price down plus volume up equals accumulation, and accumulation is highly bullish.
That is a perfect explanation. And the exact reverse is true for distribution, the text states. When price gains while volumes decrease, it is bearish.
Why is a rising price bearish?
Because the upward momentum is a facade. The price is drifting upward based on retail traders buying the hype, but the volume is dying. The massive institutions are quietly, systematically selling off their massive positions into the retail buying pressure.
They are handing the bags to retail.
Yes, they are distributing their shares to the dumb money before the trend completely collapses. The smart money is exiting the building. Yeah. So price up plus volume down equals distribution. And distribution is highly bearish.
Boom. Memorize the mechanics of accumulation and distribution, and you will ace those questions. Now, we are entering the final and frankly the most fascinating stretch of the outline, Section 6, Modern Developments in Technical Analysis. We started this journey in the 1890s with Charles Dow looking at railroad earnings in a newspaper. We mapped the 1920s with moving averages. Where has technical analysis evolved to in the modern hypercomputational era?
Wall Street today is dominated by quantitative analysts, supercomputers, and algorithmic trading. Your textbook introduces 4 advanced modern theories that attempt to map these complex dynamics. These are prime candidates for matching questions or deep conceptual multiple-choice questions on your exam. We need to dissect each one. First is the Elliott wave principle, or EWP.
Elliott wave. It sounds a bit like Dow theory, but vastly more structured and almost mathematically rigid.
It is a direct descendant of Dow theory, but with much stricter parameters. Ralph Nelson Elliott developed this in the 1930s. It's a theory that attempts to map long-term, predictable patterns in stock price movements based on the extreme predictability of crowd psychology. According to EWP, major market moves do not just happen in random zigzags. They take place in exactly 5 successive, mathematically proportional steps, which Elliott compared to tidal waves in nature.
So in a bullish upward market phase, what do those 5 specific waves look like?
The sequence is highly specific. Wave 1 is a strong upward impulse wave. Wave 2 is a downward correction wave where early buyers take profits. Wave 3 is another massive upward impulse wave, usually the longest and strongest as the broader public jumps in.
That's the meat of the move.
Exactly. Wave 4 is a complex downward correction wave. And finally, Wave 5 is the last upward impulse wave, driven by pure irrational exuberance before the entire trend reverses. 5 successive steps, up, down, up, down, up.
And in a prolonged bear market, the Elliott wave sequence simply flips.
Correct. The reverse flow is observed. A massive wave down, a dead cat bounce up, a second brutal wave down, a slight recovery up, and a final capitulation wave down.
The psychology here is fascinating. Why 5 waves? Because it perfectly maps the human emotional cycle of a trend. The initial discovery, the doubt, the mass adoption, the hesitation, and finally, the blind mania. Just remember the number 5 for Elliott wave, 5 successive tidal waves. Now, moving from the psychology of crowds to the physics of nature, the next concept is chaos theory.
Chaos theory was not born in finance. It was adapted from advanced physics and mathematics, where it is used to examine complex systems that appear completely random but are actually governed by highly systematic deterministic laws. Think of weather prediction, fluid dynamics, or the mapping of coastlines.
How does predicting the chaotic movement of a hurricane apply to the S&P 500?
When applied to technical analysis, chaos theory attempts to prove that the seemingly random, chaotic daily wiggles in stock prices, the noise that Dow theory ignored, are actually non-random. It introduces the concept of fractals into financial charts.
Fractal.
Yes. A fractal is a mathematical pattern that looks the exact same, regardless of how far you zoom in or zoom out. Chaos theorists argue that the structure of a 5-minute stock chart looks mathematically identical to the structure of a 5-year stock chart. Because human psychology is fractal, the market is fractal. It argues that underlying, highly complex mathematical order exists within the chaos, which requires a complete revision in traditional linear theories of finance.
So the market isn't a coin flip. It's a highly complex weather system. From physics, we move to Russian macroeconomics. The third theory is the Kondratiev wave theory.
This was developed by Nikolai Kondratiev, a brilliant Russian economist who actually contributed to the first Soviet Union 5-year plan in the 1920s. He was tasked with proving that capitalist economies would eventually collapse.
Did he?
Well, in studying hundreds of years of data, he discovered something else. Unlike Elliott waves, which look at specific stock charts, the Kondratiev wave focuses on predicting massive, multi-decade macroeconomic supercycles.
He theorized that capitalist economies move in massive 50 to 60-year waves, driven by major technological innovations or fundamental structural shifts. Things like the Industrial Revolution, the age of steam and steel, the electrification of the world, or the mass adoption of the internet.
Correct. And his theory tracks how these massive technological waves ripple through the economy, affecting inflation, interest rates, and the fundamental structure of global finance, like the implementation of floating exchange rates or the eventual elimination of the gold standard. The Kondratiev wave theory argues that these massive 50-year supercycles act as the ultimate overriding tide, making shorter-term 5-year decision cycles less predictable unless you understand where you are in the macro supercycle.
To give the MBA student a modern context, many Kondratiev theorists believe the 1990s dot-com boom was the peak of the information technology wave, and right now, the global explosion of artificial intelligence represents the chaotic birth of an entirely new 50-year Kondratiev supercycle.
That's a great application.
Which is an incredibly perfect transition to the final and most cutting-edge concept in Unit 8, neural networks. Here is where the textbook enters the realm of science fiction. We have gone from drawing trend lines on a piece of graph paper to deploying weaponized AI to trade the markets.
This is the absolute frontier of technical analysis. Neural networks are highly advanced computerized trading systems used to build dynamic forecasting models. They are modeled on the biological neural networks of the human brain. They ingest vast, almost incomprehensible amounts of historical, financial, and trading data, looking for hidden, non-linear relationships to predict future prices.
How does an AI neural network do this differently than a human quantitative analyst with a massive spreadsheet and a moving average?
It comes down to computational power and the ability to see multidimensional patterns. A human can look at price and volume. Maybe they overlay a moving average and a momentum indicator. That's 4 variables.
Right.
A neural network can simultaneously analyze the interaction of 10,000 different variables. Technical data, fundamental data, sentiment analysis from millions of social media posts, real-time options flow, macroeconomic indicators, and extract intricate patterns that are simply too complex for human cognition or traditional linear computer algorithms to notice. They cycle through millions of permutations of the data repeatedly until a predictive pattern is formulated.
And the most terrifyingly brilliant part is that they learn, right? They aren't just static formulas.
Exactly. The critical component of a neural network is the feedback mechanism, specifically a process called backpropagation. The AI makes a prediction on where a stock will be tomorrow. Tomorrow arrives, and the AI compares its prediction to the actual reality. If it was wrong, it calculates the error, feeds that error back into its own system, and automatically adjusts the mathematical weights of its internal connections. It learns from its past errors in real time, constantly refining its own predictive accuracy.
And the textbook notes that some of the most advanced systems take this a step further by utilizing genetic algorithms. This blew my mind. We're talking about Darwinian evolution applied to algorithmic trading.
It is literal survival of the fittest in a digital environment. A genetic algorithm creates hundreds of different trading bots, each with slightly randomized trading rules. It unleashes them on historical data. The bots that lose money are killed and deleted. The bots that make the most profit are selected to mate.
That is wild.
The system mathematically combines the winning traits of the best bots, introduces a slight random mutation, and spawns a new generation of even better trading algorithms. This evolutionary process allows the system to mutate and dynamically adapt against a constantly changing flow of market data, evolving its strategies completely independent of human intervention.
It is utilizing the exact same computational framework that scientists use to map the human genome, but it's being deployed by Wall Street hedge funds to predict if the S&P 500 is going to break through a resistance level on a Tuesday afternoon. That is staggering. It completely redefines the landscape of security analysis.
It really does.
And with that, we have thoroughly mapped out every single concept in Unit 8. You are fully equipped for this exam. But before we let you go, let's do a rapid-fire outro to lock in the most critical, highly testable concepts for your prep.
Let's run through it. First and foremost, the core philosophical divide. Fundamental analysis focuses on intrinsic logical value. Technical analysis focuses purely on past prices, volume, and the foundational belief that the market is 90% psychological and only 10% logical.
Dow theory. Remember that the market is the ultimate gauge of macroeconomic business conditions. Memorize the 3 trends. The primary trend is the macro tide, lasting 1 to 3 years. The secondary trend is the corrective wave, lasting 3 weeks to 3 months, and predictably retracing 33% to 66% of the primary movement due to profit-taking and bargain hunting. The minor trend is the random daily noise lasting less than 3 weeks.
Volume acts as the ultimate lie detector to confirm a trend. A price rising with heavy volume is highly bullish. A price dropping with heavy volume is highly bearish.
Market breadth compares the total advancing stocks against the declining stocks. If the Dow is going up but the cumulative breadth line is going down, that divergence is a massive red flag signaling an impending reversal.
For sentiment indicators, remember the contrarian logic. High mutual fund cash liquidity indicates a bearish sentiment for managers who are too scared to invest. For the put-call ratio, heavy call volume is bullish, heavy put volume is bearish, but watch closely for sudden swings in the ratio to signal a turning tide in mass psychology.
Moving to the math. Moving averages smooth out chaotic data, but they are lagging indicators. A buy signal is triggered when the real-time price violently crosses up through a flattening moving average line. Relative strength mathematically ranks stocks to find accelerating momentum.
For charting, candlesticks provide instant visual momentum with open, high, low, and close data. A standard head and shoulders pattern 3 peaks showing buyer exhaustion is highly bearish. An inverted head and shoulders is highly bullish.
A breakout occurs when price shatters a historical support or resistance level, validated by massive volume. And remember the smart money. Accumulation price slowly dropping but volume surging is a bullish sign of institutions secretly buying. Distribution price rising but volume dropping is a bearish sign of institutions secretly offloading to retail.
Finally, the modern developments. Elliott wave maps the market in 5 successive tidal steps. Chaos theory finds fractal mathematical order in seemingly random data. Kondrativ wave theory maps 50-year macroeconomic tech cycles. And neural networks use dynamic AI, backpropagation, and genetic evolutionary algorithms to extract complex, nonlinear patterns. And a crucial final caveat from your textbook. Technical analysis is not meant to be a complete substitute for fundamental analysis. The most successful portfolio managers use technicals in conjunction with fundamentals, utilizing charts to perfectly time their entries and exits into fundamentally sound companies.
You now have the definitions, the mechanics, the psychology, and the memory frameworks you need to absolutely dominate Unit 8. We wish you incredible success on your MBA exam. You have the tools, you understand the why, and you are going to crush this.
But before we officially sign off, I want to leave you with one final provocative thought to mull over, a question that extends far beyond the pages of your textbook. We established at the very beginning that the entire foundation of technical analysis is rooted in the belief that the market is 90% psychological. Every support floor, every panic sell-off, every head and shoulders pattern is driven by the very human emotions of fear and greed.
Right, the human element.
But as we just discussed with the rise of neural networks and genetic algorithms, what happens to those classic charts when eventually 90% of all daily trading volume is being executed by emotionless, hyper-rational AI bots? When machines are trading against machines at the speed of light, will human psychology still dictate the underlying trends? Or will the algorithms eventually evolve a completely alien type of market behavior, creating patterns and charts that the human mind cannot even comprehend?
A fascinating paradox for the modern MBA to solve. Good luck on the exam, and until next time, keep diving deep.